Hello students, today I would like to welcome you all to this video. In this video, today we are going to learn about the provision for doubtful debts. So let's start with the definition. So the provision for doubtful debts is created on the debts who are in doubt of making payment. So it's an estimate that this much number of our receivables will not going to pay us, so that we create this provision on our trade receivables at the end of every year to see how much of our trade receivables, mean the debtors, will not be able to pay us. Like, it's an estimate of the debts who will not be able to pay us. So why do we do that? Because of the implementation of the prudence concepts. Prudence concept says that our assets should not be overstated and profits should not be overstated. So provision for doubtful debts will give us the true value of our receivables. After deducting the provision for doubtful debts, we will have our net receivables, that will be our true receivables. So how do we do this provision for doubtful debts? So first of all, we know that we will have trade receivables. If we do have different categories of trade receivable, means the age wise, like some of our trade receivables are 30 days old, some of our receivables are 60 days old, some of our receivables are 90-day old. So we have a different percentage of these receivables. Like for the 30 days olds, there will be a 0% chance of the irrecoverable, and for the 60 days, so we have like 3%, and for over 60 days we have like 10% chance that some of this amount will not be able to recover. So we do that with the relevant percentage. So let's have a look on. So we'll have a trade receivables. Let's suppose if we'll have a trade receivables of 10,000, that will be on 31st of December 2007. So the relevant percentage is given, so that will be given to you in the exam. So for example, we have it says that create the provision at the rate of 5%. So what we are going to do, we are going to create this provision by multiplying this by this number. So the provision will be provision for doubtful debts will be 10,000 into 5%, that will give us the amount of 500. So that will be the provision figure, because we do not have any provision in previous years as in this scenario. So this will straight away goes to the income statement as an expense. So if we are I'm going to show you how we're gonna do this. So whatever you are going to calculate this provision, that will be your closing balance of the trade of the provision for doubtful debts account. So here we are going to make the provision for doubtful debt account. So I usually told my students that in the O-level syllabus or IGCSE syllabus, we have two accounts that starts with the word of provision. The first one is provision for doubtful debts, and second one is provision for depreciation. So both of these accounts, provision for doubtful debts and provision for depreciation, they will start from their balance on a credit side. So the balance brought down will come up here. So in this scenario, as we do not have any opening balance like the balance from the 1st January 2007, so there will be nothing come up here. So always remember in the provision questions, whatever the provision that you are calculated on the closing date, like on this date 31st of December 2007, so that will be your closing balance. So write down 31st of December 2007 here, and that will be my balance CD, and it is 500. If an account starts from balance BD on a credit side, because why do we have this balance on a credit side? It's our liability? No, it is not our liability. It has a credit balance because it will reduce our trade receivables, so it is a reducer to our assets. So assets comes on debit side, so the provisions will come up on credit side. So that's why we have a credit balance, opening balance here. So we will have a closing balance here on the debit side. So we are going to close this account, and we will close this account by 500, 500 and 500. This will goes to the income statement. So because there was no provision at the beginning, so we have a provision at the end of the year, so that means the balance is going to be increase of the provision, so from 0 to 500. So all of this balance is an increase in provision, so this balance will goes to the income statement. After gross profit there will be other expenses section, so we'll write down in the expenses increase in provision. So that will be like this. So if we'll move further on to this example, so let me give you another transaction for the next year. So we'll have this balance will become our opening balance. So balance brought down, so it will be 500 on 1st of January 2008. So let's suppose if we have another transaction, it says that on 31st of December 2008 trade receivables let's suppose they are like 15,000. So create provision at the rate of 5%. So here we have the 15,000 balance now, and the provision percentage is the same as the previous. So we are going to calculate by multiplying this 15,000 into 5%, so that will give us the figure of 750. So 15,000 multiplied by 5 divided by 100, so that will give us the figure of 750. So because this figure is on a closing trade receivables, so means this will be our closing balance of provision. So what I'm going to do, I'm going to transfer this balance on this side, on the credit side, as balance carried down. So now this will be 750 on 31st December 2008. So now we are going to balance it off again. So here we have this side has a bigger value, so 750 will come up here. Always remember, when we are going to balancing off, we always add the CDs written already. So if we already have 750 balance CD, so we'll add this up, we'll transfer this to the other side, and we will deduct this 500 to get the balance of 250. That will again goes to the income statement. Now if we can notice that now there is an increase again in the balance from opening to closing. So the opening balance was 500 and the closing balance now is 750, so mean there is an increase in income statement 250, so that will again goes to the income statement as other expense. like we have done it here. Now in this year 2008, in the income statement we will have increase in provision 500. So moving on, now I'm going to give you an example of decrease in provision. So this balance again will become our balance brought down 750. So that will be on 1st of January 2009. So let's take another example. So now it says that on 31st of December 2009 we have trade receivables. So let's suppose now we have a trade receivable of 12,000, and it says that create provision of 5% again. So these percentages and these figure will be given in the question, so it can be changed. I'm giving you the same percentage for better understanding, like 5%, 5% and 5%. So in the question they may give you this data in the change figure, in the change percentage. So whatever the percentage they will give in you with the relevant date, so we are going to apply that percentage on that relevant date trade receivables. So now we are going to do is, so the provision for this year will be on 12,000 into 5%. So that will give me the figure of 600. If we will calculate this, 12,000 multiplied by 5 divided by 100, so it will give me a figure of 600. So again, as we have done in the previous example, so the calculated figure of provision we always record on a closing balance, debit side. So this balance again, it will be over closing provision balance. So I'm going to increase this line a bit, so that will become my balance CD now 600. So it will be on 31st of December 2009. So after writing down this, again I'm going to close this account. Now this time, as we can see that this side has a bigger value, the credit side. So I will write down this 750 here. So I will transfer this 750 to another side. So I will get my balance here after deducting 600, so 150. So 150, this will goes to the income statement. Now because this is an decrease in provision, so this figure will goes to the income statement as, so in the income statement we'll go to the other income section, after the gross profit. So in the other income section we'll write down decrease in provision, and we'll write down the number 150. That's how we gonna present this into the income statement. Now the next thing comes to you guys in the exam. There's a double entry of either the increase in provision or the decrease in provision. So we know that from the double entry, what do we need to debit and what do we need to credit. So if we look into the increase in provision, so I'm going to write down here the double entry. So if we have increase in provision, so if we have increase in provision, so the double entry will be, as we can see that provision for doubtful debts account is going to be credited and the income statement is going to be debited. So we'll write down here income statement debit and provision for doubtful debts credit. So the amount will be, that will be written in front of this income statement. So means the only amount that is going to be increased is not the closing balance. Okay, so usually what the students do when they are recording this transaction, they write down this balance that they have calculated by applying the percentage on trade receivables. So we are not supposed to use this figure, we're supposed to use the difference between the opening and closing balance. If it's increasing, we'll record this double entry, or if we have a decrease in balance, so we're gonna record the entry. Let me do that for you. So if we have a decrease in provision, so we are gonna record by using this figure. So in this scenario, the provision account will be debit, and the decrease or income statement is going to be credited with the amount of the decrease value, that is 150. So we'll write down 150, and we'll write down 150 here. So this is another thing that examiner can ask us to perform in the exam. So they might ask us to record the double entries of the increase in provision and decrease in provision. So the next thing is the presentation in the SOFP. So I'm going to write it down here for you. So in the statement of financial position, so what do we have to do? If I'm going back to the example that we have here at the start, in 31st December 2007, so we have 31st December 2007, the trade receivable was 10,000, and we created the depreciation of provision for doubtful debts is 500. So I'm going to show you how we're going to present at the SOFP on 31st December 2007. So SOFP in 2007, we'll go to the current assets. In the current assets we have trade receivables, and we'll write down 10,000 here in front of this trade receivable, and we will deduct the provision. Now in the SOFP, we are not going to record deduct here the increase in provision or the decrease in provision. Instead of that, we will write down the figure of provision that we have calculated by applying the percentage. So means the closing balance. So the 500 will goes to here, and we will deduct this 500 from this trade receivable to get the net trade receivable balance, that is 9,500. That's how we're gonna record this in 2007. Moving on, in 2008, if I'll come here, yes, so we have on 31st December we have receivable of 15,000 and applied the percentage of 5% to get the provision of 750. So we'll write down here trade receivables, $15,000 in the current asset section, and we'll less the provision. Now the provision for doubtful debts, coming back here on 31st of December 2008, so we have applied this 5% and we got the 750. That 750 was our closing balance of provision. So the same balance we are going to use to record this, to deduct this from our trade receivables. So here we have 750. Again, you guys have noticed I have not deducted the increase amount of the provision. So once we will deduct this, we will end up with 14,250. So the thing that I would like to show you here, that the increase in provision was 250. This balance will goes to the income statement. It will not be recorded in the SOFP. So in the SOFP we always record the closing balance of the provision for doubtful debts. I'm gonna leave this for you guys for 31st December 2009. So you guys have to present this SOFP presentation in the comment box. So what I would like you guys to show me what figure will goes to the trade receivable into the current asset section, and then how much the provision will supposed to deduct from this to get our net receivable figures. Here's one thing that I would like you to mention here, that if we have irrecoverable debts, as in the previous video we have learned about the irrecoverable debts. So irrecoverable debts, if we have any, so we have to deduct this from trade receivables before applying this provision. So this figure of trade receivables, it's already adjusted with the irrecoverable debts. So if we have irrecoverables, so we'll deduct this from trade receivable first, and then we will apply the percentage. I will solve some question for you guys to cover this topic, irrecoverables and provision for doubtful debts. The Cambridge past paper question I will solve for you guys for better understanding. If you have any questions or any comments, please share with me, so I will come back to you. So again, I'm going to remind you that I would like to see the answer from this year, the presentation of SOFP, in the comment box. Thank you very much.